Hey everyone, welcome back. We're diving into some pretty interesting stuff today. Indexed Universal Life Insurance, or IULs for short,
That's right.
and specifically how they might play a role in retirement planning. I
Exactly.
know a lot of you out there have been asking about this.
Yeah, we've gotten a ton of questions about it.
IULs seem to be gaining popularity, and honestly, when you first hear about them, they sound kind of like a dream come true.
Yeah, the idea of combining life insurance with the potential for some serious growth.
Exactly. It's like, wait, I can protect my family and build wealth at the same time? Sounds too good to be true, right?
Well, there's definitely more to it than meets the eye.
That's why we're here. We've got a stack of articles and research here.
Yeah, we've been digging deep.
So we're going to break it all down for you today, get to the bottom of what IULs are all about, and help you figure out if they might be a good fit for your retirement plan.
And what's really interesting is the source material we found this week.
Oh, yeah. What's up?
There are some pretty contrasting viewpoints on IULs.
Oh, juicy.
Some experts are singing their praises,
I bet.
while others are urging serious caution.
Okay, so we've got a bit of a debate on our hands.
Yeah, but that's what makes this deep dive so fascinating, right?
Absolutely. So before we get into the nitty-gritty, let's set the stage here. Remind everyone what exactly an IUL is. I mean, the name itself, Indexed Universal Life, it's a mouthful.
It is. It's like they tried to cram every feature into the name.
Right. So break it down for us. What are the key elements here?
Okay, so first off, it's a type of permanent life insurance. That means it provides a death benefit to your beneficiaries if you pass away.
The whole point of life insurance, right?
Exactly. But here's where things get interesting. Unlike traditional life insurance, with an IUL, your cash value has the potential to grow based on the performance of a specific market index.
Ah, okay. So that's where the index part comes in.
Precisely.
Yeah.
And it's usually tied to something like the S&P 500 or the NASDAQ.
So your money is sort of riding the coattails of the stock market, but not directly invested in stocks.
You got it. And that's a key distinction because it offers a level of protection against market volatility.
Okay, so less risk than being fully in the stock market.
Right. But, and this is a big but, there's also a limit on how much you can potentially gain.
Oh, right. The articles mentioned something about caps or limits.
Yeah, exactly. There's usually a cap on the maximum return you can earn, even if the index performs exceptionally well.
So it's like a trade-off. Less risk, but also potentially less reward.
Exactly. And that's why understanding these nuances is crucial before jumping into an IUL.
Now let's talk about the universal part of the name. What does that signify?
That's where the flexibility comes in. With a universal life policy, you often have the ability to adjust your premium payments.
So if I hit a rough patch financially, I can lower my payments.
Potentially, yes. But, and I'm going to keep saying this, it's important to understand the implications.
Right, because everything's connected like some giant financial web.
Exactly. Adjusting your premiums too often can impact the growth of your cash value and even the death benefit.
Okay, so it's not a free-for-all. You can't just treat it like a piggy bank, right?
Not quite. There's a strategy involved.
Yeah.
And this is where working with a knowledgeable financial advisor is super important.
Okay, I'm sensing a theme here. Professional advice is key. But before we jump to conclusions, I want to dig a bit deeper into this whole growth potential thing.
Yeah.
How exactly does an IUL capture gains from the stock market? I mean, it's not like we're buying shares, right?
You're asking all the right questions. So here's how it works. Your returns are calculated based on the performance of the chosen index, like the S&P 500 we talked about. But instead of directly investing in the index, the insurance company uses a strategy called indexing. It's a bit complex, but basically they use derivatives or options tied to the index's performance.
Derivatives and options, huh? Sounds a bit Wall Streety.
It is a bit, but the takeaway for you is that your returns are linked to the index's gains, but not in a way that directly exposes you to the ups and downs of the market.
So it's like a buffered exposure to the stock market, right?
Exactly. That's a good way to put it.
Okay, I'm starting to get the picture here. But let's talk about those caps again, because those seem like a pretty big deal.
They are. They can significantly impact your potential returns. Here's an analogy. Think of it like driving a car. The index's performance is like the speed limit on the highway.
Okay.
Now your policy's cap is like a governor on your engine. Even if the speed limit is 70, if your car can only go 55, you're not going to reach that full speed.
Ah, I get it. So even if the market is booming, the cap limits how much of that growth I can actually capture.
Precisely. And these caps can vary significantly from one policy to the next, which is why it's so important to compare and understand what you're getting into.
Speaking of things to compare, I know there are fees involved with IULs. How do those work?
Good question. Like all financial products, IULs come with fees. There are administrative costs, charges for the death benefit, and sometimes fees associated with the indexing strategy itself.
Okay, so it's not like all my money is just going into this growth engine. There are costs to consider.
Exactly. And these fees can eat into your returns over time, so you have to factor them in when assessing the overall potential of an IUL.
And this is where I can imagine things get really tricky because you've got the index performance, the caps, the fees. It's like a three-dimensional chess game.
It can be. And that's why, and I can't emphasize this enough, seeking professional advice is paramount. A qualified financial advisor can help you analyze your specific situation, run projections, and determine if an IUL is right for you.
So if someone is listening to this and thinking, an IUL sounds interesting, it might fit into my retirement plan, what's their next step?
The first step is definitely reaching out to a financial advisor. They can help you evaluate your needs, goals, and risk tolerance and see if an IUL aligns with your overall financial picture.
Okay, so professional advice is step one. But what about doing some independent research? Are there any red flags people should watch out for when considering an IUL?
Yes, absolutely. One thing to be wary of is overly aggressive sales pitches that promise unrealistic returns.
The classic get-rich-quick scheme.
Exactly. Remember, IULs are complex, and there's no guarantee of performance. Also, be sure to thoroughly review the policy documents, paying close attention to the fee structure, the caps on returns, and the potential impact of adjusting premiums.
So basically, do your homework, folks. Don't just sign on the dotted line without understanding what you're getting into.
Exactly. And don't be afraid to ask questions. If something doesn't make sense, keep asking until it does.
Knowledge is power, right?
Absolutely. And informed decisions are the best decisions.
Okay, so we've covered a lot of ground here. We've explored the basics of IULs, talked about their potential benefits and drawbacks, and stressed the importance of professional advice. But before we wrap up, I want to bring it back to the listener's perspective. If someone is considering an IUL for their retirement plan, what key questions should they be asking themselves?
That's a great question. I think one of the most important things to consider is your risk tolerance. How comfortable are you with the idea of your retirement savings being linked to market performance, even with the buffer of indexing and caps?
That's a good one.
Yeah.
Because even though it's not direct stock market investing, there's still some level of risk involved.
Exactly. And you need to be honest with yourself about how much risk you're willing to take on. Another key question is, what are your retirement goals? What kind of lifestyle do you envision, and how much income will you need to support that?
Right, because IULs are just one piece of the retirement puzzle.
Exactly. They might be a good fit for some, but they're not a magic bullet. You need a comprehensive plan that addresses all your financial needs.
And speaking of a comprehensive plan, this circles back to our favorite topic, professional advice.
Couldn't agree more. A financial advisor can help you put all the pieces together and create a roadmap that leads you towards your retirement dreams.
All right, so there you have it, folks, IULs. Potentially a powerful tool for retirement planning, but definitely not something to jump into blindly.
Couldn't have said it better myself. Do your research, get expert advice, and make informed decisions.
And as you continue your exploration of IULs, I want to leave you with this question to ponder. Given the potential for growth, the inherent risks involved, and your own personal circumstances, where do you stand on the spectrum of risk versus reward when it comes to IULs?
That's a great question to reflect on.
It is, and remember, the more you know, the better equipped you are to make choices that align with your financial goals. Keep learning, keep asking questions, and keep planning for the future you deserve.
Well said.
That's all the time we have for today, but don't worry, we'll be back next week for another deep dive into a new financial topic.
We'll see you then.
Bye, everyone.
Bye.